Have you looked at the markets lately and thought, things seem incredibly quiet? I mean, the surface level numbers are showing this really sluggish August standard trading volume of just 15.6 billion. Honestly, it looks boring. But beneath that deceptive calm, there is literally a staggering $3 trillion moving around in total secret.
Welcome to The Explainer. I am absolutely thrilled to guide you through this today because what we're looking at is definitely not your typical quiet summer market. The August 2026 market is actually this deeply fractured landscape, completely dominated by massive, hidden institutional moves. So today, we're going to decode these crosscurrents and show you exactly where the smart money is really flowing.
Here's our roadmap for today. We'll start with the deceptive surface calm, then move into geopolitics and yield shocks, followed by the defense and energy windfall. After that, we'll dive into the shadow AI iceberg, check out some consumer headwinds and periphery signals, and finally, wrap it all up with the August strategic matrix.
All right, let's jump right into part one, the deceptive surface calm.
If you're a retail investor glancing at your portfolio right now, it's completely understandable if you feel like liquidity has just dried up for the summer. And hey, the trading volumes absolutely confirm that feeling. The year-to-date average usually sits at about 18.25 billion. A standard August slows down to maybe 15.6 billion. But today, we are scraping by at just 13.83 billion. In this incredibly thin liquidity, top-level indices like the Dow Jones and the S&P 500 are just languishing, grinding down about 0.5%. It really paints a picture of complete market apathy.
But while the broader market is seemingly asleep, there is an absolute storm brewing underneath. Since hitting its lows back on July 29th, intense institutional accumulation has driven a stealth 20% bull market in semiconductor chips. We can see this tracked right here by the PHLX Semiconductor Index. Get this actually marks the shortest bear market for chips since March 2020. So the surface is calm, but man, the underlying currents are incredibly aggressive.
Moving on to Section 2. Geopolitics and yield shocks.
So what is actually driving this fractured behavior? Well, to understand the bond market right now, you have to trace the geopolitical transmission mechanism step by step. It starts with geopolitical escalation. Specifically, we're talking about heightened tensions between Iran and Oman, combined with a hardline U.S. nuclear deterrence stance. This entirely neutralizes the anticipated Trump put on the market. Now that leads directly to step 2, an energy spike, with Strait of Hormuz tanker seizures pushing oil prices way up. Step 3 is the inflation reality, as the market starts pricing in structurally higher supply chain costs. And finally, step 4, the 19-year high in Treasury yields.
The absolute crucial takeaway here is this remarkably tight 10-day correlation coefficient of 0.85 between WTI crude, which is sitting around $85.26, and the 30-year Treasury yield. That yield has spiked to 5.31%, which is the highest point we've seen since June 2007. So what does this all mean? It tells us that long-duration bonds aren't really trading on your typical domestic economic data anymore. Right now, they are trading almost entirely on oil-driven inflation fears.
Okay, let's look at Section 3, the defense and energy windfall.
With yields spiking and global tensions rising, corporate capital is rapidly shifting to adapt. Let's look at how big oil is handling a massive, war-driven commodity windfall. They are sitting on an additional $75 billion in free cash flow for 2026 alone. That is massive. Now, while some of that goes to balance sheet repair, like BP cutting $7 billion in Q2 liabilities, and standard shareholder returns, the high probability path here is M&A consolidation. You see, drilling carries long-term bust risks. Instead, these firms are poised to exploit the current window of friendly U.S. antitrust enforcement to consolidate via all-cash acquisitions before the 2029 presidential transition.
And hey, it is not just energy. The defense sector is seeing a massive, heavily insulated capital injection. Prime contractor RTX has secured a 7-year, $22.9 billion contract to replenish depleted U.S. stockpiles. We're talking about ramping up Tomahawk cruise missile production by 10 times and Patriot systems by 4 times. And what's really fascinating is how this trickles down to subcontractors, like L3Harris for rocket motors and General Dynamics for warheads. Because stockpile replenishment has solid bipartisan support, this massive ecosystem ramp-up is entirely shielded from any upcoming November midterm election volatility. It's a sure thing.
This brings us to Section 4, the shadow AI iceberg. Now, while defense and energy are absorbing physical capital, the tech sector is executing something much more secretive. That quarterly spending on AI data centers and NVIDIA chips that you constantly hear about in the news,
That's literally just the tip of the iceberg. It's just the visible volume the market prices daily, hidden entirely below the balance sheet, locked away in SC footnotes as future financial obligations by giants like Alphabet, Meta, and Oracle, is a staggering $3 trillion in shadow capex. This is a colossal rotation of capital, and it's happening entirely out of plain sight.
Let's see how this builds into real-world strategy with what we call the integration pivot. Look at SpaceX. They aren't just hoarding hardware anymore. They are aggressively moving toward direct software monetization. They actually just acquired Cursor for an eye-watering $60 billion. The financial impact of this vertical integration is simply massive, projecting SpaceX's 2027 revenue way up to $115 billion, jumping from a $97 billion baseline. It's a total game changer.
But this tech aggression is colliding head-on with geopolitics, and supply chains are being forcibly realigned. Commerce Secretary Howard Lutnick is actively enacting a regulatory blockade, pressuring domestic tech firms against sourcing memory chips from Chinese suppliers like CXMT. The structural tension here is huge, especially for companies like Apple that desperately need tight memory availability. But there is a massive domestic beneficiary in all of this: Micron Technology. By capturing this forced domestic sourcing demand, Micron has successfully retaken the crucial $1,000 price level.
All right, let's pivot to Section 5, Consumer Headwinds and Periphery Signals.
We've looked at the institutional heavyweights, but we absolutely cannot ignore the downstream reality. Let's look at a classic consumer bellwether, Disney. Over at D23, Disney's strategy was all about restoring the magic of the 2010s by leaning into proven IP like Zootopia 3 and Frozen 3. But that vision? It is slamming into a brutal consumer reality. U.S. movie theater visits remain down 27% compared to pre-pandemic levels. The habit of cinema attendance is just structurally broken at this point. Combine that with recent live-action failures like Moana stalling at $124.5 million and Snow White collapsing at $87.2 million, and Wall Street is firmly entrenched in a strict show-me holding pattern. Bottom line, the everyday consumer is simply exhausted.
And this exhaustion is echoing in peripheral market signals that are completely flying under the radar right now. First, there's regulatory risk. Government probes are starting to pierce the opaque walls of massive sports empires like Mark Walters' Los Angeles Dodgers. Second, climate economics are creating some real disruptions. We're seeing severe European droughts turning riverbeds to sand, which is actually forcing the shutdown of nuclear power reactors that rely on that river cooling. And third, consumer leverage. Millennials and Gen Z now account for over 75% of new premium signups, and the average age of a new U.S. Amex Gold Card user has plummeted to just 29. They are aggressively using credit to justify high fees, signaling a highly leveraged, vulnerable consumer base.
Finally, let's bring this all together in Section 6, the August Strategic Matrix. We've covered a tremendous amount of ground today, from shadow capital to struggling cinemas. When we pull all of these disparate signals together, the big picture actually becomes pretty clear. We've mapped out the macro and micro catalysts right here against the headwinds. On the tailwind side, you've got the highly visible defense supply chain ramp-up and massive capital deployment engines like Big Oil's $75 billion war chest, plus that hidden $3 trillion shadow AI capex. But on the headwind side, you face structurally compressing margins from 5.31% 30-year yields, climate shocks, and severe consumer exhaustion, which is perfectly modeled by Disney's box office attrition. Systemic capital isn't just sitting there. It is actively migrating toward defense hardware, energy consolidation, and hidden AI, while entirely abandoning interest rate-sensitive and consumer-reliant sectors. So I want to leave you with this final thought. We've seen today that the low-volume surface of the market is really nothing but an illusion. Billions, even trillions, are rotating aggressively right below your feet into defense, energy M&A, and hidden AI infrastructure. With capital fleeing the surface for these deep currents, you really have to ask yourself, is your strategy positioned for where the smart money is actually going, or are you just floating on the deceptive calm? Definitely something to think about. Thanks for joining me on this explainer, and keep learning.